you to be as candid and to keep the discussion quite conversational, not sort of super formal, and really talk more on, nuts and bolts, not necessarily very high level discussion, but quite an operational level discussion, if that's all right.
Yeah.
Okay, so we're at time. Thank you everyone who's joined us this afternoon. Welcome to the conversation on refinancing the energy transition. For those of you who have been following the webinars of the CEW Center for Energy Finance, we've been having a Financing the Energy Transition in Emerging Economy series. This is the third of that series, which focuses on refinancing and is more specific to, of course, the Indian context today. I'd like to thank very much all the panelists who have joined us. I'll introduce them in just a moment. But before that, I'd like to sort of set very quick context of this conversation, as well as a series of this conversation. For those of us who don't know us, the Council on Energy, Environment and Water is one of Asia's leading research and policy institutions. We work on a variety of issues, here and now issues like energy access, renewable energy, as well as power sector, but then also think about long-term issues such as deep decarbonization of the energy mix, industrial decarbonization, as well as sort of transitions in the technology, finance, and trade aspects of water and energy, of the changing climate and energy. Given all of this work, we found that there was a dedicated need for monitoring clean energy markets, which is why 1 year ago, we founded the Center for Energy Finance, where both Vaibhav and I work. And the idea for the Center for Energy Finance is to keep a dedicated eye on market movements in the solar, wind, energy storage, and electric mobility markets, where we try and act as non-partisan market observers, and we try and bridge the information asymmetry, as well as provide solutions for real market challenges, whether in the form of financial instruments or innovative business models. Today's discussion is really one of the starting questions for me when I came to work in India's renewable energy market was shortly after the announcement of the 175 gigawatt target. And those of you who were monitoring the market then would remember that the Ministry for New and Renewable Energy had invited both investors as well as power producers to come and make commitments. And the commitments made for capacity addition were far more than the commitments made for investing in these projects. And while things have gotten much better since then, that equation hasn't really changed. Our ambition for capacity addition and the bullishness of that market continues to be much greater than anything in the investment or sentiment, or it doesn't necessarily always translate into the same kind of bullishness of the investment sentiment. So really the question that we're here to discuss today is, where's the money going to come from? And we have one idea, but also we have a very stellar panel with us to give us other ideas. Some of them also have money, so they'll maybe just give us the money. So that being said, I'll introduce everyone who's on the panel and then hand over to my colleague to make a short briefing presentation, and then we'll get right into the conversation. So with that, first I'd like to welcome Dr. Ratin Roy. He is the director of the National Institute of Public Finance and Policy, and a friend of CW, I'd like to say, and a leading voice on all that is good and all that is not good in the current state of affairs in the market. I'd also like to welcome Anita George. She's the Executive Vice President and Head of Strategic Partnerships of CDPQ India. And Ms. Sharmila Chavali, who is the Principal Financial Advisor for Northern Railways. Dr. Dhruva Purkayastha, who is the Director of the US-India Clean Energy Finance Facility. And Naveen Khandelwal, who is the Chief Investment and Strategy Officer for Hero Future Energy. So really, I think between them, we have quite a few diverse, if not almost all the relevant voices represented. But before we hear from any of them, I'd also like to introduce you to my colleague, Vaibhav Pratap Singh, who's a senior analyst at the CEW Center for Energy Finance and the lead author of an innovative instrument that we'd like to talk about today that we've just been studying. So with that, I'll hand over to you, Vaibhav.
Thank you, Kanika. So maybe we could just begin with the presentation. So the slideshow is taking a while. Just view for a moment.
Okay.
So good evening all. My name is Vaibhav Pratap Singh and I work as a senior analyst at CEW Center for Energy Finance. Today, I would be talking about a limited period subsidized credit enhancement for domestic RE issuances that we have designed over in the Center for Energy Finance. So the idea is to cover why we need this instrument, what is the need, what all this instrument is about, and how we can actually implement the instrument. So moving forward, as Kanika has already introduced us through this broadly, I work with CEW and we have 7 focus areas and I work with Center for Energy Finance. So let me set the context for you, why we are over here. So India's energy transition is marked by the scale of its ambition. As you could see in the screen, the target is 450 gigawatts by 2030. This means that India would need around 16% CAGR growth year on year until 2030 in capacity addition. For this, you would need both transmission network as well as storage for RE integration in future. And it could be another supporting infrastructures like RE parks that we have got used to. All this would require investments. And in terms of investments, just the generation capacity will cost $200 billion around. So, and also additional investments would be required for equally capital intensive transmission upgradation, storage, and other supporting infrastructure. So before I move into the barrier part of this, so let's see how renewables have performed over the year, or especially in the face of COVID-19. So they have been less disrupted, with the worst of decline only at 10%, while the entire power sector generation was down by 20%. Similarly, as expected, the investment activities should be in a lull over the period, but we had the lowest solar tariff discovered during this period of around 2.36 kilowatt hour. So investors are happy and they want to invest into RE. And this could also be seen by the second graph on the right side that says a large amount of capacity got awarded during this period. That was around 8 gigawatt in the month of June. And on the equity side, the two listed stocks, Adani Green and Azure Power, they have been outperforming the broader market, and really more than 100% returns of Adani since year end is a thing to see. So what is the problem? The scale that has attracted so many investors out there is also the problem. And why? Because India's financial sector may not be able to sustain this growth. And as listed out over here, the banking sector, most of the banks are hitting back exposure limits. Some of the banks are under PCA and thus cannot make any fresh lending. There is an impending increase in NPAs, and thus both NBFCs and banks will face a huge capital erosion and may not be able to make any fresh lendings. Also, NBFCs have been suffering from a liquidity crisis since 2018. And this could be, if you extrapolate along with the GDP, the lending by NBFCs would give you some indication what role these NBFCs play in the Indian infrastructure development and GDP or the country as a whole. So what could be the solution? Ideally, bond markets should provide the gap, fill up this gap by refinancing operational projects. So there could be two options. Either you go overseas, but overseas, you have a plethora of investors who are looking for investments into green, but this carries currency risk, which makes these usually expensive, and also the tenor remains limited in general. Also, there is a risk of countries' sovereign rating getting downgraded, which can limit the so this as a source of funding. This is because if, let's say, India is rated today in the just at the investment rate and it falls below it or falls in the even a notch below it, a lot of investors who are looking to invest into India will just vanish because of the return and risk appetite expectations. Similarly, there could be an alternative provided by the domestic bond market, which has its own limitations. It is around 97% of it, as visible on the screen, is dominated by institutional investors. And with institutional investors, they have a restriction. They can invest only into something above AA or A. So very high credit worthy clients only they could invest into. So such as we could say that India has a very underdeveloped bond market with very low liquidity and most of the times very short-term maturities. And in terms of implications for RE, none of the existing RE project on a standalone basis has a AA rating, and thus without any external support will not be able to tap the bond market directly. So no question of refinancing. So there is an alternative that you go credit enhance your bond and get it refinanced, but that is very limited. Why? And this is the one of the basic reasons that why only 2 credit enhanced issuances have been there in the RE space. Is the all-in cost that makes these issuances usually very cost incompetitive, and thus briefing up all this into 3 points. The banks do not have a sufficient headroom. RE loans on their own cannot tap the bond market, and CE pricing is uncompetitive. So this calls for a regulatory intervention that for helping India meet the targets. Otherwise, the targets would be at risk. So let me tell you more about what credit enhancement, that is one of the solutions that we are proposing, what actually it is. So as seen by the green bars over here, credit enhancement is an outside support that helps to reduce the distance to default as depicted by the green line. So the green line with credit with an external support increases. So their distance to default increases, and similarly, there could be a subsequent increase in the ratings of the project or the issuance. And thus you could tap the bond market as well with this support. So let me give you also some highlights of what we have done over here and how. So for India to meet the targets, we thought of what could be the number, let's say the current, how we can develop, what is the capital required or the debt required to double up the existing capacity. So the figure with the 80-20 debt to equity ratio came at around something around 76,000 crores. With a split of BBB and A, BBB being the base. Usually most of the RE projects are rated at least BBB because that is the minimum qualifying criteria for bank loans to make them lendable by banks, most of the major banks. And A, some of the, so this comes at around, for all this, you need around $650 million to be precise of support to enhance the facility. Yeah, and this is all based on the CRISIL default study for 2018, which we have interpolated for 10 years of default rates. So how this would be actually, we propose to get it done. So there would be a facility manager, which under the guidance of a board of trustees could give out these guarantees to the bond issuer, and bond subscriber could subscribe to this. This will essentially help to open up the bond market to the RE. A new class of investors could be created in India, and also with a track record. And also we have a very interesting sunset clause of 5 years for this facility. So after 5 years, we feel that the industry may not need support and there would be an abundant track record and they could tap the market. So in short, this entire mobilization activity could help refinance around 76,000 crores worth of loans that if banks want to invest back into this sector could help develop the existing solar capacity as shown. This would lead to, and what is the cost? Just 4% of government of India's annual power and RE budget. So a leverage of 16 times. And which when you compare with other alternatives for public money, let's say AIF, IDFs, or even InvITs, this seems to be the money that could get the most leverage. And in terms of GDP, the important factor is all these projects, if they come online, they could add around 1% to the country's GDP while creating 49,000 jobs. So this was my presentation in very short. So, and the report is also live. You can just browse it. We will share this within the chat function where you could use it. So that's it from my side.
Thank you, Vaibhav. Very precise intervention. Yes, Ratin, we are coming to you.
I just need a clarification so that I'm clear.
Go ahead.
Whether the credit enhancement is going to come from the budget of the government of India? I wasn't clear.
I mean, with public money, it's we can be a line item in the budget. It can be done through allocations that are already done to the Ministry of Power or Ministry of New and Renewable Energy. But regardless, it would have to be something that it's all public money. Yeah.
Okay. Thank you.
But just to be clear, actually, it's 4,500 crores spread over 5 years. So it's only 900 crores a year. So not a lot of money, just saying. So I think, Vaibhav, you can stop sharing the deck now. And before we start the discussion, and we have a full hour for a detailed discussion before, we wrap up, etc. And Anita has to go. But so please, for everyone who is attending, please feel free to use the Q&A function to send in your questions. We will discuss them, as well as I'd encourage panelists to sort of type out answers if you so like. And also, again, I made this request to you guys offline, but I'm going to make it again now to be as candid and precise in your response. So maybe I'll ask you to sort of have quick reflections on what we are proposing, but I'll add sort of just in terms of the lens of the perspective I'd like you to use when you're responding to the instrument that we proposed. And Ratin, if we can start with you. Of course, the way that we've presented it, as well as the way we've thought about it and designed it, has been very much about how do you create liquidity to realize India's clean energy ambitions, right? And while liquidity seems to be all the interventions that are doing the rounds nowadays are focused towards that, but mobilizing money from the bond market for infrastructure as a class is not something that is just in line with India's clean energy ambitions, but would have benefits beyond that as well. So having sort of a deeper and more robust market should be something that we should anyway. And if you also are able to realize green ambitions, and that's great. So maybe from that lens, if you could reflect on what we are proposing.
No, I think it's what I like about the idea is its simplicity. But and there are experts here who will be able to tell you far more about how the idea would work. I mean, the amounts involved, as you're rightly saying, are not very large. And in principle, if it's only for guarantees, as I see, then it need not even be spent. Right?
Yes.
If I understand it correctly. I'm understanding you correctly. It essentially creates initially a contingent liability until it is invoked. Do I understand that correctly?
Yeah, you are correct.
So then it's not really an interest rate subvention. It's not a cost of capital subvention. It's basically providing guarantee support.
Yes.
Yeah,
So
it's an
then there is the technical point I want to make is there's no immediate budgetary implication. Right? The budgetary implication only comes, there's a budgetary implication in terms of the liabilities side of the budget, but there is no, you have to make a provisioning, but if it's not spent, then next year's RE doesn't come up. So really the whole thing turns on the unanswered question here, to what extent do you expect the guarantees to be invoked? And I'd be interested in knowing the answer to that question. Because in a situation of systemic risk, the probability that guarantees in any sector would be invoked are high. So if it is the case, from where I'm sitting, that the guarantees specifically in the RE sector are less likely to be invoked, implying a lower risk than a vanilla investment by government, then the obviously it becomes more attractive. And for that, of course, as this is energy, I need to understand how this proposal works, assuming that the DISCOM problem remains as violent as it is today. Right? Because you have generation, but if you don't get paid for your power, then you produce renewable energy or gobar gas or whatever. We're all in the same boat. So that is the second level, I think, question it would be useful to hear from your experts on. Finally, I want to say there is no need for this to be necessarily budget funded. If the proposal is clean and if the guarantees are limited, then I think this is a good instrument for the IFC to contemplate. The amounts are not large, and I do not see why this cannot be something that the IFC could do. Thank you.
Great, thank you. Maybe just sorry, a layer on top of what you're saying. It's the interesting part of it, obviously, is the leverage that you can create, right? So whether it's IFC money or whoever's money, it's just that you can, if you have to pay it back, then it isn't a first loss pool. So it has to be grant money of some variety, but it does create a fair amount of leverage. But also there are new risks that are coming up, right? So like the DISCOM problem that you identified has definitely gotten worse. But also what has, there's demand risk, which is not a risk that we had ever seen in India. And that's because we don't know how quickly demand will recover, or, well, a lot of the recovery actually has already happened, but how quickly it will grow. Which is, and the growth in the power sector has actually been the foundation stone of the energy transition, because we aren't phasing anything out. But maybe with that, if I can turn to you, Sharmila, because there have in the past been some government supported credit enhancements as well. And I know you have in the past been on the board of IIFCL, which also provides a similar, has a similar facility. So maybe keeping that in mind, do you think one of the flaw or one of the reasons that facility wasn't as successful as it could be was because it didn't have this kind of grant money attached to it?
Okay, hi. Two things. If I may, Kanika, I'll go back to Dr. Roy's question also. If you recall the 2016-17 budget announcement for a credit enhancement facility, I think Dhruva and I had worked on it jointly to structure it thereafter. That eventually intended to have no government support. We would get in money from outside, including from the multilaterals, etc. And that's how it should be, because you shouldn't have government coming in and doing this. That said, the IIFCL kind of guarantees were slightly different. They were not hardcore for the renewables, they were for infrastructure on the whole. And IIFCL itself, the PPP models that it was studying, there were various issues that we get to detail to. I mean, it required too much time to get into it. I just want to bring in two factors which would be relevant to your study. When we look at what's happening today, this is very different from possibly what was there 4 months ago or 5 months ago. And like you said, we do not know when demand is going to recover, etc. So this facility was probably something that should have come in about 1.5 to 2 years ago, maybe in 2016-17, when we started anticipating what would be the problems, assuming there would be no kind of a pandemic, what would be the problems that infrastructure would face. Just a couple of things I want to say. Infrastructure as a sector is extremely slow to react to external developments, including in energy. And across the world, the financing is tending to get more and more domestic. Indian solar is a slight deviation from that. We get a lot of interest from overseas. So we had even thought of a kind of a modified hedging facility for neutralizing the forex risk. where again, when I was in finance ministry, they were very clear that the government shouldn't be providing this. There'll be some cost to the investors themselves who are coming in. But two things that have happened, which I think we need to be very conscious of in the renewable sphere, is we need to watch what is happening overseas, because those trends tend to get reflected in India with about a 2 or 3 year lag. For instance, right now, solar. In India itself, we've seen a slight downtick in the interest of investors. If you see what's happening in the US, they are finding that even all of us know that it's the capex that is the most important, then there's no fuel cost. So operational costs are fairly all right, handleable. They're finding that more and more parties are reducing the O&M costs by not putting in preventive maintenance, corrective maintenance, etc. And before coming for the seminar, I was reading something. They've just found that in a survey, a 30% increase in operational expenditure is going on across the board. Now in India, we're faced with, we understand, tariffs that are going to hit the sector. They're going to also possibly, like we said, see prolonged demand risks. So how does this facility need to be tweaked? Because you wouldn't want to be in a position where you are starting to look at risky assets. And the reason I'm saying this is, again, we go back to the infrastructure, larger sector of infrastructure. Most of you who work in the renewable space have always complained that the renewables gets crowded out in bank lending by the big brother, which is the power sector, the conventional power sector. Conventional power is largely public sector driven, whereas renewables is largely private sector driven, right? And for us in the renewables area, we do need to look at what is happening to the cost of debt. The bond market is very good. So again, we go back to a 2016-17 proposal where we worked with CRISIL and the ADB on securitizing the bank assets. We worked with the largest public sector bank in India. And I find that 2 months ago, there was an announcement from the finance ministry that they will be looking at this model of securitizing assets, because that's where the good assets, including from the power sector, need to move out of bank lending so that the initial funding can come back to things like renewables, which are the flavor of the month. That kind of a great path is what we need over here. But that would also require some amount of cleaning up of the balance sheets of the big banks, because otherwise you'll be perennially having this problem of not finding the initial financing, which can be refinanced. So this is one of the things that we need to be aware of. There are two other things that have been happening in the last 3 months, especially after the pandemic. One is insurance costs for the projects are increasing sharply. We need to be aware of that. And I know we have someone from industry who would possibly be talking about this. The second and third concerns that I have on this area is, as a government, maybe as a policy enabler more than actually doing something in this field, we need to be looking at two areas which are fairly neglected currently. One is R&D in disposal of solar panels. That's going to hit us very, very strongly. Again, I read some engineering journals where, a week or so ago, where they say that the glass can be used in our EV segment. I don't know how far this is feasible, but we need to be doing research in that. We also need to be doing massive work in battery storage. We don't need to reinvent the wheel. We need to pick up on what is happening, say, in the US, which is like the most advanced in that. Now, if we take those factors, so we have some pluses and some minuses, your facility will work on a first loss basis, yes, but I like the fact that you're going to have it, it's closed-ended and it goes off in 5 years. I mean, it ends in 5 years. But when we had announced the credit enhancement and guarantee facility in 16-17, we were also expecting that we will soon have a host of such guarantee funds coming up, like, shooting up everywhere once this takes, once this gains traction. So if you have private equity now coming in, if you have the pension funds, etc., coming in, we do need that kind of a vibrant bond market. There will be a lag before this takes off in the next, I mean, it's going to take some time, so we need to factor that in. But otherwise, I like your approach to this because it does build up on what the finance ministry had originally intended to do 4 years ago.
Thank you, Shamila. Before I turn to Anita and Naveen from a more kind of practitioners where, you're doing this every single day and these transactions are your day-to-day work and activity. I'll turn to you, Dhruva, to answer the question that Rathin posed is, what is the likelihood of default? Because I know that you think deeply about the credit rating of renewable energy projects and whether they are rated accurately or not. So maybe if you can, of course, reflect on the idea of the facility overall, but also very specifically on this question.
Okay, thanks a lot, Kanika. And I think Sharmila did mention our earlier work. And so I'll just not, I kind of agree to start with all of what Sharmila put in. But I'll just start with saying, before I get to answering your question, I'll just start with saying that I was just trying to write down that, you know, banks to bonds is the classic evolution, which is what infrastructure, energy, and renewable energy need to do. I mean, that's overall financial sector development, deepening, countries' progress, economic growth. You need to recirculate capital, and that's what savings to intermediation through capital markets and banks. So the track on which, on the premise on which it is built is in my view, the right way to go. The question is, in infrastructure, energy, and therefore in renewable energy also, we have not seen this work, and therefore why it does not work, because it has been presented in the presentation that we have made that our bonds are in AAA and AA, 90%, 97%, and therefore there is an institutional dimension for investment that we cannot invest. So therefore, in all these dimensions, we understand and we are taking this as a basis that credit enhancement is required. And a credit enhancement will effectively lift it up from a BBB or a A to a AA or a AAA, probably a AA, to make it placeable. So there is a cost of that credit enhancement, and that cost of that credit enhancement, the proposal here is to subsidize that cost, and it's a public subsidy for that cost of that credit enhancement. So far, so good. But now let me come to a couple of issues before I get to the ratings or the issues of ratings. At some level, Sharmila and I, working earlier, and then I was in IFC, we clearly kind of found that probably the ratings were not appropriate. But notwithstanding the fact that institutionally we cannot change credit ratings, we have to go by credit ratings because the regulator uses it, market uses it, government uses it, so we accept that the credit ratings is there. If you look at the market spread, and when you come to a spread between a BBB and an A, you will see the BBB spread is pretty much high. It's 300 plus basis points. So what is it telling you? It is basically telling you that, look, if you reach a BBB, I want to price you higher, because, and that is where it leads to Rathin's question on what is the probability of default. That is also given in CRISIL's data, which I think Vaibhav has used, or your report uses. They have used the transition matrix, and therefore it comes to saying there is a probability of default there. And if this is a probability of default, this is the expected loss, and therefore I need this much of money to protect against expected loss, which you are saying, asking from the budget allocation of 1,000 crore a year. Budget allocation, I'll leave that to Rathin, but in my mind, every year it needs to pass through the budget appropriation to allocate 1,000 crore, and hopefully that if that is possible or not, we'll park that aside. So that is the price of potential default, and it is addressing the price. So the credit enhancement availer will pay a price which this report is reducing, and therefore it becomes more placeable, or it becomes more enhanceable. But there is one point here. In credit enhancement, there are two issues. One is, now sorry for getting technical here, because you said get into more granularity.
Yeah.
And therefore the issue is, one is the expected loss, which is supposedly to be priced out, If I can give you a guarantee, I price the expected loss. But what we miss out over here is just pricing is not enough. And that is exactly where we get into a problem with regulation in the financial sector. Now we'll come to that, leave that regulation. Sharmila knows that pretty well. We run foul of regulation in the financial sector, not allowing us to do it, but that's a separate topic. But where we get into trouble is, what is the capital required to be kept? because I price it out. But there is a black swan situation. In a black swan situation, there is something technically called an unexpected loss. So the theory says I price out the expected losses and therefore this is the subsidy, but I still need to provide capital. I still need to provide capital to take care so that the credit enhancer's balance sheet is not wiped out with all losses occurring at a instantaneous point of time. Not a reality, but then there are regulatory prescriptions which tell you that you have to provide that much capital, and therefore they tell you that, okay, capital adequacy is risk weighted and therefore it's 9%, it is 15% here for infrastructure. So that much capital will also have to be sourced. So that's an incremental amount of money, whether that can come from the market, come from multilaterals, that's a separate issue. Therefore, so that probably answers your question when you said expected losses is the average probability of default, but we have to take care of what is possible in a black swan or an unexpected loss situation also. The problem of credit ratings, we did discuss, but we have to leave it as it is, because if credit ratings are overestimating the risk of renewable energy, which it is doing, the only way that can be corrected today for energy transition is to use what Bank of England is doing in terms of brown and penalizing factors, green supporting factors, where you bring in a capital charge or an increased risk or a lower risk for being green. Unless that is factored in, and credit ratings today do not factor that in, because green is good, but there is good green and there is good credit. So the choice is for the investor, whether I take good credit or whether I take good green, which may be poor credit. So that's not sorted out yet. So that is where credit ratings, or the problem of credit ratings not factoring in green comes in. Last point from my end is the budget subsidization issue. Yeah, I believe and I agree that over a period of time, information asymmetry would come down, and therefore you would be able to price that more better and therefore start this off. But in addition to subsidizing this, there will need to be a capital set aside, which basically then brings me into a structure of saying there has to be some form of capitalization. And last point I missed out was on the regulation. We'll have to get the regulator allow this product. Today, in regulation, it falls between the stools. It is neither under IRDA's purview nor under RBI's purview. So we end up into a no man's land of saying, what is this financial guarantees product? It is credit guarantee as defined by IRDA is actually a working capital, a stock in trade guarantee. So there is a regulatory barrier that needs to be solved, and this is more on the action side. Thanks.
Thank you, Dhruva. Always lots of food for thought, and I think lots of things for Vaibhav to respond to as well. But before that, I'll just circle on. Anita, can you still hear us? Or should we go to Naveen first?
I can hear you.
Okay.
I had some problems with my internet, which keeps going in and out, but now I think I'm okay.
Okay, great. So maybe I'll pose the next question to you before we go to Naveen. So Dhruva said it very nicely, actually. There's good credit and there's good green, right? And how do you sort of square the circle, so to speak, between the two? And ideally, given your you've been sort of monitoring what's going on in India's clean energy sector for many, many years in various roles, but maybe before you sort of take on what from a CDPQ point of view, but more generally, if you look at it, if not this, what is needed to open up the bond market? Because it's not going to be enough for us to just keep accessing bank and NBFC debt, right? So to what extent does this open that up? And then also more specifically from, what you were mentioning earlier as well, work that you've been doing through your investee platforms, how does something like this influence just the kind of capital that can be put into the market?
Thanks, Kanika, and hello to everyone. It's been a very interesting discussion thus far. I would say, always as a long-term investor, the first thing we look at is the fundamentals of the sector itself. And Dr. Roy mentioned the DISCOM issues. I think you mentioned, Kanika, the demand issues, and then other things like land acquisition, etc. So I think as an investor, and here I'm talking about equity investment, right? You would look at all of these issues, especially the payment risk. And that kind of, in some ways, is the core of should we invest or should we not? And the fact that SECI was created and that a lot of the offtake in the early days, especially for solar, was done by the NVVN or NTPC construct, that helped a lot. And CDPQ, as a long-term investor, we are 50.8% shareholders in Azure Global Power. And Azure has actually issued 2 green bonds for a total of $850 million in 2 tranches. And a lot of the issues that Dhruba and others mentioned in terms of the rating and in terms of the relative pricing of debt finance from banks vis-a-vis debt finance from the bond capital markets have influenced those decisions, but particularly for refinancing, the green bond issuance seemed like the best solution at that time for Azure. Our other platform is CLP India, which actually did the first green bond in renewables for the wind sector back in 2015 for 600 crores. So at that time, equivalent to about $100 million. And this was a domestic bond issue. And CLP India being rated AA, it was an easier task for them. Now, coming to your product of credit enhancement, it's very interesting, but not to be a wet blanket. It's a difficult product because a lot depends on some of the issues that have already been mentioned. So I think the best way to look at it broadly is this really trying to protect liquidity shortfalls, or is it insolvency, right? And depending on which it is, you have different structures that make sense. So if it is, a liquidity issue, then you can structure the guarantee in such a way that it provides the liquidity to the bondholder if and when needed, and the issuer has a chance to replenish that when things get better. So it's just a temporary hitch, and COVID would be one example where demand has come down, so you're not earning the kind of revenues that you were, and therefore you may need like a bridge, right, till things come back to normal. So in those instances, something that addresses the liquidity need is replenishable. Those are the kinds of products that I think would work. But when the fundamentals of the sector, like things like state governments reneging on signed PPAs, this kind of thing is really where you need, I mean, my sense is that no matter what kind of props you put up, those fundamental risks investors will not be willing to take. So just to say that when we look at the offtake risk, we look at the track record of states and we say, okay, which are the states where we have a high level of comfort that reneging on signed contracts has a low probability. So I think that's something which we cannot escape. That's fundamental risk that needs to be addressed. The other issue is really the pricing. So very often people think a guarantee is unfunded and therefore it's a contingent liability and therefore should have a lower cost than, let's say, a straight loan, a bank loan. But typically, and Dhruva will know this from our mutual days in IFC, for lenders, for guarantors who are AAA rated internationally, the cost of funding, especially today, is relatively low. So it doesn't really feature into the equation of, because it's a guarantee, it has to be cheaper. In fact, in IFC, the way we looked at it was, regardless of if it's a funded or an unfunded, the risk premium stays the same. And here the regulatory aspects come in, like there was a cap on the guarantee fee, regardless of whether you were taking it up 2 notches, 3 notches, etc. So here we need some flexibility to truly reflect risk and the risk mitigation that the guarantee is serving. The second thing I would say is, here today there is an issue for the sector where, as I think Vaibhav mentioned, the banks have their own challenges, NBFCs have their own challenges, and therefore long-term lending for infrastructure or even credit enhancement that could be done by some of these institutions is not happening, because it's really risk aversion to the sector regardless of the kind of enhancement. So in other words, it would have to be enhanced all the way to AAA by a very respectable institution for banks to start taking note and saying, okay, this is a bond issue worth investing in. So I think the need for enhancement goes up so much because of sector exposure issues or fundamental risk issues, that no matter how much you enhance, the appetite doesn't come up to the point where there is a big noticeable change in terms of these forms of financing. Having said that, I do think globally there's larger and larger pools of capital for green investments, as well as for a new asset class that's being talked about a lot, which is sustainable infrastructure. And there are different institutions working towards defining what that means, similar to the green bonds exercise that was done several years ago, and third parties who would verify whether a project qualifies for sustainable infrastructure labeling. But there are these large pools of global capital that is really looking for these kinds of well-rated, I would say investment grade rated green or sustainable infrastructure. So in designing your credit enhancement product, I think that's something that you could target and keep in mind. And there again, I would say this issue of liquidity versus insolvency is very important. And there you would have to work with the rating agencies, because the rating agencies have this approach of probability of default and loss given default. The off-takers that we have, like the discoms, even if they are in a bad financial state, the probability that they will go bankrupt and not ever be able to pay is small. And that's the feature around which, if you can structure it as a liquidity replenishment type product, you may have more interest and uptake from investors. So I'll stop there.
Great, thank you, Anita. I think that we keep trying to solve for non-power sector challenges about, like, whether it's bond market depth or whatever else, because just power sector challenges are so hard to solve for. And the excitement around green bonds, which has really been doing the rounds for so many years now, has always come up against this kind of barrier of, all that is well and good, green bonds being a new source of debt, but the kind of risks to that borrowing don't change, whether it comes from a bank, NBFC, a domestic bond market, or foreign bond market. So I think that's a really good segue actually to turn to you, Naveen, for a two-part question. One, as a company that has done a green and was one of the earlier green bond issuers, was it worth it to do a green bond issuance, to pay for all that certification, to be compliant with the rating, all of that? I mean, really, to be quite blunt about it. And secondly, are we solving for a problem that maybe doesn't exist? I mean, is access to debt even the biggest problem that you face as a company at the moment? You're on mute. Sorry.
Yeah, sure, Kanika. I would address both of your points. And I think there's an advantage of speaking at the last, because apart from your own perspective, you get to reflect on others' perspective and then comment. So that's good. But let me start by appreciating what CEW has done. I think that's at least a good beginning. Whether that results into this actually getting implemented or not, but at least that has put a lot of people's mind in a particular direction, and this is provoking a lot of thoughts. So I'm sure we would reach to some progress, if not definitely this one, but something else, or maybe combination of both. So now coming to, first let me address both your points and then I'll share other perspectives. So blunt answer to your first question is not materially or not meaningfully. And anyway, that was done long back. That was 2016, and it was a small domestic $45 million issuance. But even the international sort of green bonds are yet to see a meaningful or reasonable pricing differential that all of us have been talking about. Climate bond certification or S&P certification or Moody's certification, all those things are good as a starting point, but someday all of us are hoping that someday secondary market will start giving some premium to this. And at least if this doesn't give definite price benefit in the beginning, at least it brings new class of investors or certain set of investors who are only socially responsible investors. So this definitely helps, not tangibly, but intangibly. Now, answering our second question, which is this really a problem or are we overthinking? No, I think I would say this is a really big problem and we need to solve for it. And my starting point would be, this is such a large problem that not any single solution can make it work. I think we need to work on multi-pronged strategy across all products, all solutions. So credit enhancement on domestic side is one. Making ECB framework a little more liberal, especially for infrastructure, and within that, especially for renewables is second. Focusing on the fundamentals of the sector, as Anita mentioned, improving the DISCOM's fundamental problem is third. And then maybe slightly more regulatory policy interventions, which take all this to a logical and positive conclusion. That's fourth. So I think we need to do all of these. Now, to answer on your specific domestic enhancement thing, so I think I went through the report which Vaibhav and team and you and team have put together. It's quite comprehensive, though there are certain assumptions which could be discussed based on practitioners' inputs, like 10 years non-amortizing structure is somebody giving that and all those things. But without getting into that detail, it's a good work. Pricing remains a big challenge. Regulation remains a big challenge, but that's a good starting point. Now let me start with highlighting why renewables are in this position in which they are, especially in India. So I think renewables on one side have advantages of getting classified as infrastructure, but still have disadvantage of getting classified as power sector thing. We share a lot of things with the power sector, but we don't also with a lot of power sector, in the sense, a lot of operating risks which other technologies of power sector face, this sector of renewables does not face. But the problem is the counterparty or your buyer remains the same. And if the buyer's health is very, very weak, that is what is causing the lowest ratings. So if you were to do deep dive into causes of lower ratings, I think 85 or 90% of that will go to only counterparty risk. Otherwise, if you look at other risks, whether it is asset quality, cash flow, operating risk, I think those are significantly lower vis-a-vis any other infrastructure asset or any other maybe operating business or any balance sheet. So I think we need to rightly address the fundamental problem of discoms. I know that is not easy. Entire country, entire policymakers, central government, everybody is trying that. It's a big problem. But I think slowly, gradually, we need to incentivize that right behavior. And I think I have a couple of small thoughts there, because this reminds me of the earlier days of 2007 and 8, when country was starting ultra mega thermal power plant of 4,000 megawatt each. There was a new design of payment security mechanism. I think someday if we start doing separate accounting for renewables, separate green energy accounting at every discom level, I think half of the problem is solved. Because green is not causing the kind of stress which other assets are causing, and not only generation assets, but major problem is in the transmission and distribution, right? So I think separate accounting of green energy would be a very good starting point. Second point I would like to highlight is the aggregation part of it. So another beauty of renewables is, unlike many other infrastructure assets or power assets, is for 4 gigawatt asset, you can aggregate at least 30, 40, or if not more, at least 15, 20 assets. That gives you benefit of diversification, and that addresses a lot of risk which Ms. Sharmila and others highlighted, like asset quality and all those things. I think asset quality is very easy to take care. There are enough and more tier 1 developers like Hero, Azure, Tata, who will not get into things which others are doing, whether O&M cost going here and there and other things going wrong. So I think those things are easily addressable. So asset quality is done. Resource study is also reasonably done. As long as we take care of discom issues, then we would do a good job in terms of improving the credit ratings. Now, last 2 points from my side. The probability of default, Mr. Roy's question. So probability of default, again, if we were to ask the frank answer from rating agencies, keeping aside a discom related risk, how many defaults they have seen in renewables, and especially when renewables have become the mainstream in last 8 to 9 years, post accelerated depreciation days, right? When non-serious players used to invest into the sector, I think very few. There are situations of delayed payments and delayed things, but not defaults. So that's where I think this credit announcement, so sector needs more liquidity than default redressal. Default is still very, very low probability event in case of renewables, because there are very limited externalities to the sector. There are very limited operating risks to the sector. Once it is constructed asset, then I think it is significantly de-risked assets. And that's why that brings me to my last point, is segregation of project lenders versus asset investors. What is currently happening is everything is getting mixed. Project lenders are supposed to take risk of partially the development and then mainly the construction. Then the asset should change hands and it should go to asset owners, long-term asset owners. So that is not happening. Capital recycling is not happening at all. Some good private sector banks, NBFCs, everybody tried to support the sector, but then they got very quickly full. And now because recycling is not happening, everything has come to a standstill. Multilaterals are supporting it. But I think what we need, apart from, as I mentioned, multi-pronged approach, apart from credit enhancement, is nudging public sector banks to lend. Because after all, if you look at it, renewables is still less than 20% of the sector, right? Of the larger power sector. How many 1,000 crores we have actually used? Not much. But when it is seen in the total bucket of power sector, that's where the problem starts. So I think we need to take public sector lenders also along. We need to keep them educated along with us, because there is a psychological barrier of anything below rupee 3 is unsustainable, unviable, low credit quality and all that. I think we need to address those concerns, that even 2.6 makes commercial sense. What matters is not the absolute number, but the relative number of project cost, generation and levelized cost of energy. As long as cost of energy is still making sense for developers or equity investors, then I think that should flow in. So that discomfort which they somehow have developed, I think the moment that gets addressed, if not more, I think $10-15 billion flowing into the sector is not that difficult. That's my view. And same is true for power sector focused lenders like REC, PFC. IREDA and PFS have still done something, but REC, PFC's exposure to renewables, I think is abysmally low. So that also has a meaningful gap to capture. So I think on one side we need to nudge these public sector banks and power sector focused bank people. Second side, we need to liberalize the ECB, because we can't think of funding everything domestically, though we should We should increase percentage of domestic funding. And third is the trade enhancement approach. And trade enhancement also, I think institutional intermediation is going to go a long way. I agree with Anita. SECI's intermediation has done such a wonderful job for the development of sector. Similar thing if we can do, if we introduce two focused institutions who can actually do this job of trade enhancement seriously, sincerely, and along with all the stakeholders, I think that is going to go a long way. Thanks.
Thank you, Naveen. I think you've actually already answered one of the questions that was posed in the Q&A about the viability of actual prices, which is always everyone's favorite question. Obsession with LCOE, I think, is our power sector national pastime. But that being said, before we turn to the other questions in the Q&A, I'm going to hand over to Vaibhav to maybe make some clarificatory comments of our study and its assumptions and methodology, but also to pose other questions to the panelists.
Yeah, so thank you, Varika. So there were lots and lots of questions regarding the study about is it you can dip into it again and again. So on the liquidity front for the bond issuance, for all the calculations, we have assumed that you can dip into the first loss guarantee again and again up to the guaranteed amount, because that is the usual process for guaranteeing a bond. And regarding the credit rating, so credit rating exercise, as Dhruva mentioned, exists as it is, but it would be a long-term requirement of the sector that we change the rating methodology. Maybe we are combining two issues. The thing that we were trying to address is the shortfall of capital over here, and the other was the sector facing the problem, different risk that was similar to the power sector, like counterparty risk, that has been solved to an extent by using these intermediaries like SECI, NTPC. So if we can continue in this fashion, or if India, or let's say government infuses 10 crores into SECI, and this thing can sustain up to, let's say, 30% of renewable integration into the grid, then how will you actually get the capital into the sector? Will your financial institutions be able to support this? And also on the side of, and moving now to the other part of the solution, let's say, why not markets outside India? So going by the recent example, you might be aware of SoftBank trying to raise a bond overseas. They were not able to raise it because of different issues, or so investors not being confident of it. And similarly, the Azure bond that came up with a very big fanfare out there was downgraded in the very first year. So these taps can run dry anytime. So hope that these things will help, and maybe we can discuss it later. And let's move to the next part of the questions and answers. So since everyone spoke of the counterparty risk being the biggest, so what do you feel is the most critical challenge to open up the debt financing for renewable energy projects? And maybe we can start with Anita on this, she being on the buy side of the problem, and what she feels is strongly can help this out.
Thanks, Vaibhav. Just on Azure, I think when they were initially rated, they were rated a notch higher than all other green bonds. But then as things in the sector went the way it did, they were downgraded. But then once CDPQ increased its stake in the platform, it has again been upgraded in terms of ratings. So, which indicates that risk perception in the market is something, and especially in rated bond market, is something which you will see these kinds of ups and downs. Talking about the fundamental risks and what can we do to address it. So one definitely is, as Naveen mentioned, having very credible sponsors who have track record, I think gives comfort not just in the bond market, but also to lenders. And one of the things we've seen in both our platforms is the kind of lenders as well as proposals from investment bankers on different types of products, which is very encouraging. But this is, few and far between, too few, I would say. And that's where I really think, and I hope my colleagues, ex-colleagues from IFC and World Bank won't beat me up, but I truly think we have to do something transformational in this sector. And there is only so much of Band-Aid solutions that one can have. And encouraging DISCOMs to consider ways in which they can improve their financials, bring in new capital. And we've seen it. We've seen it done in Mumbai, in Ahmedabad, in Delhi, in Calcutta. So it's not as if we don't have examples of different models that have actually improved the health of the DISCOMs, right? So one is really for multilateral institutions and the governments to come together and say, okay, how can we provide the breathing space that these institutions will need to put their house in order? So in some ways, I would think that that would move the needle much more than having a few credit enhanced bond issues. If you ask me for another really long-term source of capital, which today in India is completely untapped, is the Indian pension funds themselves. So again, due to regulations and maybe lack of familiarity with investing in these types of sectors, they are conspicuous by their absence. And if you think about it, CDPQ is handling the money of pensioners from the province of Quebec, and we are putting that money into the Indian renewable sector. So how about the pension money of Indian citizens? And I think that will really force some kind of greater discipline in the sector. Of course, one has to be very selective, very careful, and do it step by step, baby steps. Maybe partnering with NIIF or some other institutions in the first instance. But I think the time has come for us to really unlock some of this capital. What I'm told is that currently they have about $200 billion, and this is soon to go up to about $500 billion. So here's a source of funding which is completely absent from the sector. And the third, I would say, if you do a credit enhancement type product, you have, especially if it's grant funded, you have to be very careful that you don't distort the rest of the market. And there has to be some kind of a market test, because often we've seen these experimental pilot type things come in, and for a short period they may create some excitement, but it's again a distraction and a distortion of the market. So I'll stop there.
So thank you, Anita. That was really wonderful. So let me bring in Dr. Rathin into this also. So because what are his ideas? How can we bring in, let's say, pension funds or Indian pension funds into investing into RE? Or what could be the other sources that RE could tap?
Well, I don't know, because the answer to that question, very simply put, is a systemic one. It has nothing to do with RE. Unlike CalPERS, I do not think the EPFO or other pension funds or that IAS pension fund are looking for anything other than good return. And since a lot of relatively risk-free public debt is available, they go there. I think that came out in your presentation also. So, but I actually am going to sort of try and take this forward by asking another question and zeroing in on. I was a bit confused by what Mr. Khandelwal said because I'm not a sector expert. So if 95% of the risk is counterparty risk, and the counterparty is the DISCOM, then that seems to be, that should logically lead to a huge rise in the probability of default calculus. In which case, you might as well think about ways in which to reduce the counterparty risk rather than provide a guarantee subvention, right? I don't really have much more to say. I think your operational experts have put the matter very, very clearly.
I think you're very right, Dr. Roy. That's the heart of the matter.
I was wondering.
And if I may add, Mr. Roy, so I think part of that has been seen also in last 3-4 years. As I mentioned, SECI's intermediation has made so many people interested in the country's renewable sector. Lot of, as Ms. Anita mentioned, pension funds, international investors, everybody is looking at India. But they're still saying only 3 people counter NBC, SECI and Gujarat, right? So we need to make other states either compete with Gujarat or become partially like Gujarat, or if we can't make that happen, because I know that's not easy, all of us are Indians and we have seen this for decades, then we need to put other institutional intermediations like SECI. Not exactly what SECI is doing. SECI is doing more on the sectoral side, but maybe on financial side. Reducing counterparty risk, I think I totally agree with you, will do such a great job for the sector. I want to add one more thing. Sponsors are important, but look at with all due respect to everyone and all the sponsors, within Hero Group companies, I think Hero Future would unfortunately get the lowest rating. Within Tata Group companies, Tata Power to my mind would get one of the lowest ratings. This is nothing to do with Tata Group or parentage. This is because of your counterparty. And within infra also, look at the road sector. Road sector, because of NHAI as a counterparty, gets so many AAA ratings. And look at the kind of capital flow which is happening. Look at what Macquarie bid out for the tender, which was kind of earth-shattering number. I think that was some 7-8% yield for a TAT project, I think around 8-10 months back. So once counterparty risk is mitigated, I think Indian infra has reached to that stage of maturity with the help of good sponsors, good technology, good intent people, that all other things will be taken care and all other risks can be mitigated as long as counterparty is done.
So, Sharmila,
may I jump in?
Yeah.
Weber?
Yeah, Sharmila.
Yeah, okay. I just want to address a couple of things. I think Naveen has also spoken about it. One of the questions that was asked was when Arunab said, are we just kicking the can down the road unless we address a lot of issues? But here I think we have to make a distinction between the asset quality risk of a renewable project and for the conventional power. So yes, the DISCOM payment kind of issue is not as major right now for the renewable side as it is for the conventional power. In fact, my worry is more when you just get reports yesterday and today that SECI has again imposed a cap on the tariff, which is, I think, Rajasthan, they've done something in spite of MNRE saying there will not be any more tariff caps. So for me, those are the kind of issues which are on a larger policy level that the government has to address. The second, I think Anita asked a very valid question, which is always asked of government, on why the Indian pension funds are not getting into these issues, into these kind of investments in infrastructure. Unlike, say, Australia and Canada, the pension funds in India are relatively new. They don't have that kind of sophistication where you have specialists in green energy, etc., who are advising them as investment managers. And I think, like someone had mentioned earlier, getting even EPFO to consider infrastructure as an exposure class, I think it took us about 3 years for them to say, okay, they can consider it, caveated by various things. So they will get there eventually, but the original idea for the credit enhancement fund was actually meant for the best of class, where you have to push it almost above sovereign. It's already at the top. It's not meant for everyone who has some kind of a project risk that is so huge. It's meant for the top who can attract overseas funds, which is what we need coming in into India at this stage. And unless we can circle back to that and also getting the NIIF for putting in the money, I don't think we are doing the right thing. Shubha had also mentioned the credit rating. The credit rating agencies in 2017 have come up with an infrastructure credit rating scale, which would be very useful here. They also introduced something called a green tag for such rating. This addresses the question I think someone had asked about the greenwashing projects, because now investors are going to be asking whether something is really green. It's not just the source of fuel, but everything is green. So maybe it's time now for government to start enabling these kind of things also to come to rate a project.
So thank you, Sharmila. This is turning very interesting. But we also
I just wanted to come in here to address Rathin's point, which is left hanging. If you are okay, I just take 2 minutes.
Yeah.
Okay, Rathin, there is an issue on counterparty risk. The point here is, I think Arunabha's question and Sharmila's response, the issue is not of guaranteeing poor credit. The issue is not of guaranteeing poor quality of credit. A poor credit does good to no one. Poor credit goes bust. It does not create jobs. It becomes an NPA for the lender. The project does not perform. A guarantee is about improving the investability of an instrument whose credit quality is under suspect today. Is under suspect because you don't have the information to determine it. This information asymmetry leads to play conservatism and risk aversion. And therefore, the response to Arunabha's question here is, it is not about kicking the can down the road. It is about playing it safe. If you can play it safe, the markets do not move as in corporate bond markets. Point number 2, wanted to clarify counterparty risk. The perceived apparent understood counterparty risk is of discounts. However, as Naveen was saying, if you look at data over the last 15 years, and if you figure out default, there has not been defaults. So the question is our perception, but why? The problem is ultimately the investor, whether it is the institutional investor or the bank, they take comfort in saying it will ultimately devolve to the sovereign. So I have a delay over here. So the confusion here is of saying there is a delay. So therefore, do you need a payment security mechanism as was done for REWA, which was structured by IFC and invested by IFC also subsequently, maybe I'm not remember, but definitely was structured and bid out by IFC. And that kind of a structure to assure that there is an investment over here and there is a protection. And therefore, what we are bringing in over here is the SECI and NVVN are acting as risk diffusers or counterparty risk diffusers.
Yes.
Is what makes the bid happen and not leaving it. But if you actually look at data, when rating agencies come in and they look at data and historical data, so for them, there is no default. There is no default over here. The question therefore brings down to saying, then why is it lower over there? It is lower by the nature of its asset class. The nature of its asset class is what we need to change for that asset to become an investable asset. And Naveen did make a point, get this construction risk out, de-risk the assets, give it to long-term pension holders. That's the answer to Vaibhav's question. Can we have completely de-risked activities? And I'll draw references from toll roads here, where it is about having built it. They call it the reverse BOT in India, where I have built it in the public sector. Those unmanageable risks are not there in the private sector. And then say, take the toll road, toll it, manage it so that losses are less, leakages are less, and therefore you are getting even pension funds are looking at it, not only CDPQ, there are others whom CPPIB and others are looking at it, and even I Squared Capital is also looking at it. So I just wanted to clarify this point between counterparty risk and actual what the rating agencies talk of.
If I can just come in, because this is very useful, Zuba. I thought the counterparty risk is not just about delays in payment. That is quite serious. I don't see why in this environment I should be locking up my money. I have other sectors to invest in. I can buy biscuits. So why should I be locking up my money in a sector where the delay float is increasing? I also thought the problem is that they keep rewriting the rules. No, there's a contract renegement problem.
Yes, surely there is.
So that will also raise the risk. No.
No, sure, though the risks are there of counterparty, risks are there of contract enforcement, risks are there political at the state level. Sure, there is. But we are talking of a boundaried activity. We're saying, okay, this is for the power sector, this is for the energy sector. I really can't compare capital which wants to go to biscuits, long-term capital coming to infrastructure. Does it preferentially need to come to green? Can it preferentially come to green? Is what our common objective is.
Okay. I don't know about this long-term, short-term distinctions, but I get your point.
Okay, thanks.
So thank you. So this is turning out very, very interesting. So let me move to the, and since we are nearing the very end of this webinar, let me ask you a question. What is the role that you feel that in refinancing this energy transition, or what the green investors or government agencies or buyers, sellers, what is the role that they could help play and how it could be done? And maybe we could limit our answers to a minute each. So Naveen, would you like to give, or Anita, would you like to give it a go?
Vaibhav, sorry, I am late, so I'm going to run, but thank you very much for inviting.
So thank you, Anita. So maybe we can ask Naveen, so what is the role you as a Hero Future Energy could play to build up this market?
So I think my reply is going to be maybe again focused on 2-3 points. First is I think Hero as a standalone entity, I think this is not under discussion to my mind. It's about the sectoral thing. So all good sponsor-backed companies who are in the business for the long term want this de-risking process to continue. Contractual de-risking has happened, as Dhruva was pointing out. The AP issue is a separate issue, but otherwise what SECI has actually done is the intermediation wherein the PPA itself has been improved tremendously, right? So if we do a deep dive on the why credit ratings are low, apart from discom, which is 90% plus risk, is the asset risk and the contract risk. Asset, as I mentioned, is easily addressable. Now this is a global sector, this is a mature sector. So asset quality is kind of done. Good sponsors can take very good care of that. So second was contract. Contract has improved a lot. Now India's PPA is one of the best in the countries as long as people honor it. As one of the best in the world. As long as every state, every counterparty always honors it, that's pretty much bankable across the globe, right? So the only thing is discom. Now coming to another aspect which I think is getting missed, and I want to highlight that, is the aggregation aspect. The beauty about renewables is, unlike many other infra subsectors, is the disaggregated nature of the business. One big toll road, one big ultra mega thermal power plant could have externalities or operating risks. But to achieve that same gigawatt, you will definitely have 10, 15, 20 projects. So the process of trade enhancement, which you yourself are advocating, I think that could be done much better. Instead of one developer doing it, some institution does it, who ensures right kind of a diversification, both of technology, counterparty, location, lot of other things. And then I think automatically it will go by a couple of notches from BBB plus to maybe A plus, kind of A or A plus, and all you need is last 2-3 notches. That is my second pitch on the aggregation part of it. Third pitch is, because as Mr. Roy said, the problem is with the discoms, and discoms are quasi semi-sovereign, right? So can we nudge these 3 large investors and long investors like insurance, pension, and PF? I know it would require all those regulators to work together, but X percentage of theirs to dedicatedly go towards funding green energy projects, knowing that it is going to be liquidity management. Counterparty risk is there because it is unpredictable, unknown. It is I'll not say black box, but it is not fully open to the public. But public sector institutions or people or regulators who know that this debt is not going to go bad. This is definitely going to come back someday. So you need somebody who can hold it on for longer. Capital markets are not that holder. Private sector investors are not that holder. It can't be. It can only be a long paper holding entity or investor like pension, PF, or insurance, or public sector banks. So the moment we enable that, I think then capital flow, debt capital flow to the sector is done. And once debt is done, contract is done, then equity flow is also addressed, to my mind. Yeah.
Yes. So, thanks, Naveen. Maybe we can go in the order, like say, Kamila, Dhruba, and Rapin with their last few words on this and how the segment that they are representing, how it can help the bond market to develop or the renewable energy sector to develop.
Right. Thanks, Vaibhav. Okay. So bond markets we have discussed. We are now getting on to fundamentals and discoms. Okay. So discoms are in a poor position because they are paying capacity charges for energy not produced. One, you have power plants which are lower than 50% PLF. Take the data of last year. Lower than 50%, and they are 35, 40 years old. Take that list out and you will see their heat rates also. Step number one, close down 100 power plants. Coal power plants, close them down, dismantle them. Counterparty risk will go down. The discoms will not pay capacity charges by not producing. You are not only paying capacity charges, you are paying foreign exchange variation for all foreign exchange borrowings, which means that the dollar has depreciated from 50 to 70, which is what you are paying the coal power producer. So you are compensating the coal power producer also for, so that is our tariff determination. So once we shut down coal power plants, your unoperative, non-operative, more polluting, not required coal power plants, which is your step number one. Step number two on reduction of counterparty risk is a step towards, which stopped, is a step towards privatization. Franchisee, call it privatization, use some politically acceptable word, but you have to look at improving the operations like it has happened in Delhi, like it was being referred in Mumbai and in Kolkata. There have to be operational efficiency improvements. Otherwise, it is kicking the can down the road because Uday takes up the debt of the state government, takes up the debt, and there is more balance sheet. So that by the government program of Uday, you have actually increased the indebtedness of the discoms once again. And the third is, do not provide electricity to, well, it is 100% electrified, electricity does not go. So focus on where it is uneconomical, where cost of service is not covered, where it is not 5 rupees, it is 25 rupees, to charge 25 rupees DBT to the, which is there in the act included, DBT. So therefore use distributed renewable energy where grid electricity cannot be taken. All these three will contribute to improvement of discoms. None of them is too politically sensitive except the coal power plants, which may need a package, which may need some kind of restructuring employees, etc., etc. But that's what it can be worked out. Thanks.
Thanks, Dhruba, for these very candid replies. Sharmila, would you like to go ahead?
Yeah, hi. I know we have very little time left, so I'll just address three things that have been mentioned just now. I agree to a large extent with what Naveen has said about how green energy has to be seen differently from the regular power sector. But please remember, we are dealing with public sector banks which lent their bulk loans to the power sector at a time when green energy was not the prime energy contributor in the country. For them to have that mindset, I think Kanika had mentioned this in her opening remarks, this requires some amount of change in approach also. The other thing that we have to remember from government is aggregation of assets on the green side is essential, which is why something like the InvITs works. The first InvIT was actually in the renewable sector. My worry is that when something is working, just to coalesce more investment in it, we shouldn't tinker with the regulations in structures like this, because then we water down the quality of that investment vehicle. I see a little bit of that happening. I don't think we should do that. We have to be a little patient. But on the credit enhancement facility, I go back to what I think Dhruva has also mentioned. We are looking at notching up the best rating to slightly above, because otherwise they're capped at the sovereign. We are notching it up above that to attract the best capital which will come. It will both private equity from abroad and debt will flow in over here if we have bonds. The last thing is for the government, I think there are a couple of things they've done right, which Naveen has mentioned. They've got the PPAs right, but we're also going to be looking at a world where long-term PPAs are possibly not going to be the norm. So when we look at this, and if we also understand that we can't address the thermal power sector by just saying shut down all the coal plants, there are a lot of other implications on this. In fact, I think I was on a panel with Dr. Roy about a year or two ago when we were saying, we can't, we need to look at that too. It has to be done in parallel. It can't be done overnight. Unless we look at that also, we're going to have a very ad hoc kind of approach to what our energy mix is, with the right hand not looking at what the left hand is doing. It has to be an aggregated approach to this. And again, on the credit enhancement facility, maybe this is the this is the time to look at whether we limit it to liquidity. That is a liquidity shortfall, which is what we had come down to in 2017. The credit guarantee facility would be only for this, a temporary sort, because otherwise it just gets too expensive for any potential.
Thank you, Sharmila. So thank you, Sharmila. Dr. Ratan, would you like?
I'd like to actually second everything that Sharmila said, particularly for your future research, look at the liquidity issue a little more carefully. So let me just point out that the problem in this particular sector, as opposed to IT or somewhere else, or let me say even more than IT, or even another infrastructure like logistics, is the political economy. So I was talking to Piyush Goyal 3 years ago, the name that must never be uttered, Uday, it's become like demon, no? I'm not supposed to mention it to this government. So I mentioned it to him because I'm not a government servant. And he said, so what would you have done? I said, I would have done cash and carry. You're a buddy, you understand cash and carry. What is cash and carry? I said, you pay first and take the power. You bought into all this power market and all that. So if you just had a simple cash and carry system, where the power you wanted tomorrow, you had an escrow account, and you could buy power tomorrow, whatever price, up to what you had put in the escrow account, you'd solve the problem. Think about it. It's very simple. Cash and carry karwa. Then, whether you sell the power back, whether you sell the power to the consumer, the discount makes a loss, becomes a public policy problem for the discount owner, right? But obviously that's not going to be accepted. You've got to ask yourself why it will not be accepted. And it will not be accepted because there are political stakes in having bad discounts. Please understand that. When you have a bad discount, and one of the things I want to just point out to you, many years ago, I'm from Maharashtra. So I won't mention the government, but it must be a long time ago, 8-10 years ago. I have a friend I went to school with in Mumbai. And he was a minister in the MLA. And I was meeting him for a cup of tea, and I was sort of talking about renewable energy, and I was very excited about that time about off-grid. So I'm not your common objections. He looked at me and he used an unparliamentary word because he's from school. And he said, you want to screw me? I said, what do you mean? He said, the grid is my power. As long as the grid is rationed, I decide which villages get power, which people get power. So we have to get out of this bubble and understand there are political economy reasons for the power sector being where it is. It is a very important part of political economy. If we can't solve it, then what are the policy pathways? There are two policy pathways. One, I think I'd like with the credit enhancement scheme, if you work on liquidity, which is to say at the margin, we will be able to increase investment in renewable energy where these political economy constraints don't bite. And that will automatically happen when the risk officers take a view at the project level. If there's a political economy constraint, they will not take up your facility. If they think that the facility is going to be used to create, to mitigate risk, other than what is politely called regulatory and institutional risk, then they will take it up. So I think the idea flies for that reason. As long as you market it more modestly and look at, as Sharmila was saying very correctly, look at the liquidity issue. The second thing I wanted to say is, I think one learning I had from here is that the margin between PPP and A, correct me if I'm wrong, in this sector, and double A, at the sector level and therefore at the project level is very large for reasons that are systemic and to do with the buyer of the product. So I think what you would need is a complementary sort of research line looking forward, which tried to address this issue. And this has come out in several different directions in the seminar on how can we reduce whether it is counterparty risk or the rating differential drivers, right? And I want to say one final thing, that I think the days of looking to the public sector banks and the public sector to pick up regulatory and institutional risk are gone. The financial sector, the publicly owned financial sector in India has taken a hammering. It is the equivalent of domestic violence. Bankers are scared. You can see that with transmission. I was just saying this yesterday. Bankers are terrified. The Prime Minister, very frankly, wanted me to be frank. I'm in a position, uniquely, I think, to be frank, can call all the bankers he wants to Race Course Road, but he's not asking them one question: why are you not meeting the finance minister? So they will listen to him, as I said yesterday. They will go back from North Block, South Block, whatever, Bhavan, and they will go back to the normal behavior. There will be no transmission, and there will be very limited collateral feeding because they're scared. In those circumstances, I think these kinds of innovative measures, like you have mentioned, with sort of taking it, can be very helpful in confidence raising on part of the financial institutions also. And of course, this is other way attracting debt, etc. Yeah. So let me leave you with those thoughts. I hope they're useful.
Thank you very much. We're already over time, so I'll do a very quick wrap up and say a few words of thanks. It's almost impossible to have a conversation about the energy transition and not talk about counterparty risk. We tried very hard to make this a conversation about accessing more debt, but always. So actually, maybe in my summary, I'll start with what are we solving for, right? That we need to solve for counterparty risk is we avoid it in this conversation. We don't avoid it in our jobs. Nobody can, right? It's critical, as Naveen said. It is the largest risk we face. But that being said, this instrument has been designed to play the best game we can with the cards we are dealt. And what we're saying is all these risks as they exist today and as they've been exacerbated by COVID, unchanged, there isn't enough debt in the existing bank and NBFC sectors to mobilize the 200 billion that is required to get to the 450 gigawatt of capacity, leave alone all the associated investments that are required. For that, we need new sources of debt. The only other that we can think of is capital markets or accessing bonds. How do we do that, right? So that is what is the objective of this idea, or the instrument that we've discussed today, is accessing new debt. And the second one is creating an investor class that rewards some kind of, whether it's green or sustainable infra, or, and we can get into all talks, all types of discussion around taxonomy, etc. But what is more important is really bridging, as Shubha said, the information asymmetry, creating a familiarity with these markets, creating proof of concept. And we've already seen that happen with all the existing risks, with domestic banks and NBFCs, as well as with some international lenders, right? Where risks unchanged, they have developed a familiarity because of which costs of borrowing has actually come down significantly. And then the last aspect that I think all the panelists pointed out was around regulation, financing, and governance, right? And of course, there's a lot of open questions in the design that we propose today, which we do not suggest is the panacea, but really is just a conversation starter. All of you who have spent this time listening to us, please do write to us with suggested improvements, etc. A lot of the questions today, including a question that we just got from Amit Kapoor, were around, are you pushing the can down the road, or is this, and I think or are we trying to sort of like say this kind of enhancement throws the covers over the real fundamental risk? Not really. What we're trying to do is delineate risks, but we are not at all turning our back on the need for improved regulation, for building and a lot of capacity building, whether it's with domestic pension funds or whether it's with domestic bankers, on also on improving due diligence efficiencies, things like that. But also on risk diffusers. I think someone mentioned this phrase, risk diffusers, and I thought that was very interesting. Risk diffuser is everything from what is the role of public NBFCs like IREDA that are supposedly green banks, right? Are they supposed to have the exact same risk appetite as commercial banks, or are they supposed to be market making in some way? What is the role of then, of course, like you said, good intermediaries like SECI, and does SECI need to do more of what it's doing, or do we need new dedicated institutions to do specific things? I think it's important to identify the different challenges and then have solutions for each of them, but also to finally start talking about climate transition risk. We can no longer not talk about externalities and say, you know, green projects need to stand on their own feet. They have more than, they've done that, they've proven that the economic case for them is more than viable. But it is also, I think, important and good investment decision making to think about climate risk, both physical as well as transition risk. So with that, I'd like to thank all of you. I think we've had a really good and candid and substantive discussion. Thank you very much for your time, for your candidness, for your engagement on our proposal. I would be remiss if I didn't mention my colleagues Arjun Dutt and Gagan Sidhu, who have worked with WebHub on the design of this instrument, as well as everyone in the CW and CWCEF teams and all our peer reviewers. And lastly, I'd like to just respond to something Sharmila raised right up front, which is to tell you that we are in fact working on end of life policy recommendation for what to do for solar recycling, as well as for urban mining of critical minerals, both from batteries as well as solar PV, and also working with different government agencies on developing both the regulation, technology support, and financing support for battery storage, both for power sector as well as electric mobility. So with that, thank you very much, everyone. And we will be back again in a couple of weeks with the last of our 4-part series on financing the energy transition in emerging economies. Thank you.
Thank you.
Thank you.
Bye.